Hello everyone. Today we are going to learn the common errors in accounting. Now during the process of recording the financial transactions, there are a few errors which are committed which are unintentional. In this video we are going to be discussing in detail as to what type of errors are very common in accounting. So accounting errors are unintentional mistakes made in the process of recording, classifying or summarizing financial transactions. These errors can impact the accuracy and reliability of financial statements and reports. Now, there are a few errors which are committed by an accountant during accounting the financial transactions. These types of errors can impact the accuracy and reliability of financial statements. Now, these small types of errors, they could have an impact on the financial statements like trial balance, trading and loss account, balance sheet. There are mainly 6 types of errors in accounting. The first one is the error of omission. Error of omission. Okay. So what is error of omission? Error of omission occurs when a transaction is completely or partially not recorded in the books of account. What is error of omission? Error of omission is when a financial transaction has occurred but it is not recorded in the books at all. Okay, for example, a credit sale is not recorded at all. Okay, we are selling goods on credit to a specific customer and we are not recording that at all. When actually the goods have gone from my business, from my inventory to the customer, and the entry is not shown in the books of account. Now, what is the impact? Impact of not recording the sale transaction may or may not affect the trial balance depending on the nature of omission. Suppose say if I do not record a sale transaction of 1000 rupees, it will not show in my sales account. The balance of my sales account will not increase by 1000 rupees since I have not shown this transaction in the books of accounts. Another impact will be on my inventory. Now the goods have moved from my business to my customer's business. So in the inventory, the goods that have moved from my business should show an entry in the books of account which I have not shown because I have not recorded the transaction. So there is a two-way impact in case I am omitting a business transaction. The second error in accounting is the error of commission. Error of Error of commission happens when a correct amount is posted to the wrong account of the same type. Here the recording of the transaction is done, but it is done to the wrong account. Okay. For example, amount received from Mr. A is posted to Mr. B's account. I have received an amount on a sale from Mr. A, but I account it to Mr. B's account. So this is the error of commission. Trial balance will still agree, but account balance are incorrect, right? It will show as account received in my trial balance, but the account to which, the customer account to which I am recording the transaction is incorrect. Instead of showing in my books that I have received payment from Mr. A, I am showing that I have received the payment from Mr. B, which is invalid. This has an impact on the individual customer balances and it does not have any impact on the trial balance, right? I hope error of commission is clear. The third most common error in accounting is the error of principle. Error of principle. The error of principle arises from the violation of accounting principles. When we are not following the rules of accounting, the golden rules of accounting, if you are not aware of what are the golden rules of accounting, you can see my previous videos. I have made a detailed explanation of the golden rules of accounting, right? So let's take an example. Capital expenditure treated as revenue expenses. Now this is truly violating the golden rules of accounting. When there is a capital expenditure, we are debiting the asset. Capital expenditure is on assets, buying of furniture and equipments, land and building, these are capital expenditures and they are debited, right? So when we are treating this capital expenditure as revenue expense, since we have paid money to buy an asset, if we are crediting that asset account, it is incorrect. We are always supposed to debit a capital expenditure. Whenever we are buying an asset, we are debiting plant and machinery, we are debiting land and buildings, we are debiting furniture and fixtures. So in case due to lack of knowledge, if you are crediting the asset account, it is incorrect, and these errors occur in accounting, and this is called as the error of principle. Now what is the impact of error of principle when it is committed? It affects the accuracy of financial statements. You might not get the proper figures, you might not get the accurate figures if you are violating the rules of accounting, right? So this is the error of principle. Next is the compensating error. Compensating error. Now when two or more errors that offset each other, that is when a compensating error occurs, right? Let's take an example to be much more specific. Overstated income and overstated expense by the same amount. Okay, now suppose I have purchased goods worth rupees 2000 rupees, but I show that I have purchased goods worth rupees 2500. Now this is an overstated expense, right? So there will be a mismatch. The receipt which I have received on a purchase, in that the amount is showing different and the amount which I have accounted, that is different. Same is applicable with the income. Suppose I have made a sale of 3000 rupees but I receive 4000 rupees. It is an overstated income, right? So this is a compensating error. What is the impact of compensating error? Trial balance still agrees, hiding the presence of errors. Now trial balance will show the figures which we have accounted. The trial balance does its job. Whatever the general ledger balances show on a specific date, it will just summarize those ledger balances and show it in the trial balance. It will not detect these compensating errors like overstated or understated amounts for a specific transaction. It will not, the trial balance will not show these errors, right? So I hope compensating error is clear. Then the fifth error is the error of original entry. Original entry. Error of original entry occurs when original entry itself is incorrect. Right from the initiation. Now the trial balance is based on what you record initially. Considering the golden rules of accounting, the financial transactions that are recorded, based on those recordings, the general ledger formation will be done. And the trial balance is completely linked to the general ledger balances. Now, when the original entry is only not correct, it will definitely impact the trial balances as well, right? Let's take an example of error of original entry. Recording 5000 instead of 50,000 in both debit and credit sides. Now, when I made a sale of 50,000 rupees, instead of recording it as 50,000, I recorded 5,000 rupees. Okay, so the effect will be trial balance will show these amounts as 50,000 instead of showing as 5,000, but the amounts are ultimately incorrect. So you will not get that accuracy which is needed, as to the original entry is 50,000 but it is showing 5,000 in the trial balance, which is inaccurate, just because initially when the financial transaction occurred, that time I recorded 5,000 instead of 50,000. So this is the error of original entry. Then we'll talk about the sixth error, that is the error of duplication. Error of duplication. Error of duplication happens when the same transaction is recorded more than once. When there is double accounting that is done, that is when an error of duplication occurs. A purchase transaction recorded twice in the books. Now, suppose say I bought a printer from a specific vendor and I did the accounting in my books of accounts. I have accounted the bill today, and suppose say due to some reason after a few days I find the bill again, and once again I do the recording of that bill. So here I am recording the transaction twice, whereas the transaction has occurred only once. So 2 days ago I had recorded it, I had recorded the purchase, and today also once again I am recording the same purchase. So what is happening here is overstating of income or expenses happening over here. So this is the error of duplication. When a single financial transaction is recorded more than once, it is an error of duplication in accounting. It clearly violates the accounting concepts and principle. Right? So this is the error of duplication. So these are the 6 errors in accounting which are commonly made by an accountant. Now, how can the detection and correction of these errors be done? Regular reconciliations, trial balance analysis, internal and external audits, corrections via journal entries or rectification statements. All these are corrective actions that can be taken to avoid these errors. Regular reconciliation is one solution which can avoid these errors. Even the trial balances have to be thoroughly analyzed as to how these amounts are appearing in the trial balance. A set of few financial transactions, like a big amount of transactions can be taken, and the bills can be the bills which have been accounted can be taken and thoroughly analyzed as to which account has been debited, credited, what is the amount. These analysis can be done on regular intervals, and even audits are very helpful in avoiding the errors in accounting. And yes, rectification entries via journal entries can also be helpful in avoiding the errors of accounting. So, in conclusion, understanding accounting errors is crucial for maintaining accurate financial records. Timely detection and correction ensures compliance and enhance the reliability of financial reporting. So, accounting is the language of the business, and accuracy is the most critical factor in accounting, which can be achieved by following the accounting concepts and principles. This is it for this video. I hope you found this video helpful and informative. If you are new to this channel, please make sure you like, subscribe and tap the bell icon. I'll see you back in the next video with some other topic about accounting. Till then, take care.